So you're interested in buying commercial real estate, but you want to know the difference between a low cap rate and a high cap rate investment? The amount of work going into each property can be drastically different. Let's do a brief overview of triple net properties, how cap rates work on them, and then I'll dig into the advantages and disadvantages of high and low cap rates. What are triple net properties? Triple net properties are real property assets with triple net leases in place. In net leases, the tenant is responsible for their proportionate share of the property's expenses, namely the common area maintenance, property taxes, and building insurance. Triple net leases can leave the landlord with the least amount of risk out of the various commercial lease types. These properties are very appealing to investors because the bulk of the risk and responsibility lands on the tenant. If the property taxes go up, those costs are passed through directly to the tenant, meaning the investor's bottom line doesn't get impacted over the years of ownership. If you want to dive more into triple net investments, check out this video here. Now let's talk about cap rates. As you may have gathered, commercial real estate investments are often sold and bought based on a cap rate. The cap rate, or capitalization rate, is a measure used in commercial real estate investing to show the expected rate of return for an investment property if the investor paid all cash. This way, investors can easily compare property to property since debt terms will vary by investment group. It's calculated by dividing the net operating income by the market value of the property, and the resulting number is expressed as a percentage. Cap rates for triple net properties typically range anywhere from about 4% to above 10%, but can be lower or higher just depending on the market, the asset, and several other factors. The cap rate depicts the risk associated with the asset, such as the tenant's likelihood of bankruptcy or default. The lower the risk or work involved in stabilizing an asset, the lower the cap rate will be. And since cap rates are inversely correlated to purchase prices, the lower the cap rate, the higher the purchase price. Now for high versus low cap rates. Many variables affect cap rates, including the type of property, location, value, the market, the tenancy, and the potential of the surrounding area for growth. It is impossible to list every scenario or set of circumstances that may result in a high or low cap rate, but there are some scenarios commonly seen with both high and low cap rate properties. High cap rates. I know a lot of you are really going after high cap rates because they seem like they have higher returns, but they also have higher risk associated with the investment than low cap rate properties. For example, the property may need a lot of work, it may be located in an undesirable area, or the tenants may have undesirable leases, each of which is going to require a significant amount of work on your end just to stabilize. Properties with higher cap rates will tend to have higher cash flow, and they are less expensive to purchase. If as an investor, you are interested in improving a property on your own, high cap rate properties provide the cash flow that may allow you to make those updates happen, meaning you may be able to push the returns on a property with further capital and time invested into it. Also, lower purchase prices are usually a good thing to any buyer looking to get started in commercial real estate. Higher cap rate properties may appear like better investments because they indicate a higher rate of return and are less expensive. However, they do involve a higher amount of risk. There's a reason why they are lower on a purchase price. Additionally, properties with high cap rates are typically more expensive to maintain and require more oversight and legwork on the landlord's part. The properties are frequently tied to tenants who are not as creditworthy, often smaller local businesses that could default, leave a lease early, or risk bankruptcy. These tenants may begin with shorter lease terms or end up with a shorter lease due to default and are unlikely to renew their leases. Shorter leases increase the landlord's expenses, obviously. Not only will you not be receiving income if the tenant moves out, but you'll also have the expense of finding new tenants, paying real estate commissions, and paying for tenant improvements. Now, let's talk about low cap rates. Lower cap rates result from lower NOIs and higher property values. Properties with low cap rates, often between 4 and 6%, are typically lower risk investments. Investors are often willing to pay more for the property when it is coupled with more control over their investment capital. Assets with lower cap rates are usually in a sought-after part of town and are occupied by credit-worthy tenants that are willing to lease the property for longer periods of time. Think about tenants like Walgreens or Starbucks. They're massive corporations that have the backing to secure a lease. Chances that they'll just disappear overnight or cause damage to the property are relatively slim. Low cap rate investments have lower cash flow than high cap rate properties. Investors in these assets are not usually concerned with deriving short-term revenue from the property. They're more interested in finding a solid place to park their cash and will take advantage of cost segregation, also known as accelerated depreciation, to help boost their returns. Learn more about cost segregation studies here. These assets are great if you are looking to invest outside of your area or want to be more hands-off with your investment portfolio. You can also check out this video here if you'd like to watch me underwrite a single tenant net lease with a credit-worthy tenant, just to get a feel for how those assets work. Ultimately, there are no good or bad cap rates for triple net properties. A good cap rate for one investor may be a bad cap rate for another investor. It all depends on what you are looking for in an investment and your long-term goals. If you're willing to take the risk on growing asset value and gaining potentially higher cash flow, higher cap rates are for you. However, if you're looking for more security and consistency from your investment and prefer maybe a hands-off approach, lower cap rate investments are more your style. If you would like to dive even deeper into the world of triple net properties, check out this video here.